What is the stock market and how does it work? Would you like to achieve financial freedom? Would you like to be wealthy like the billionaires around the world? The stock market is one of the tools to earn passive income. If you are aspiring to be rich, you need to use it to achieve your financial goals. In this video, I will teach you about the stock market and how it works. Long ago, hundreds of ships were used by the Dutch East India Company in the 1600s to trade gold, porcelain, spices, and silk throughout the world. As you can imagine, this involves many expensive trips around the world. To fund the costly journey, the company requested private citizens to contribute money to support the expensive trips. And in return, they will receive a portion of the ship's earning. This arrangement allowed the business to afford longer trips. Typically, the longer the journey, the more profit to be made. This generated a lot of income for the company and the citizens, resulting in a win-win situation. The Dutch East India Company unknowingly established the world's first stock market by selling these shares of profit. Today, there are schools, professions, and even entire television channels dedicated to the stock market. Today's stock market is far more sophisticated than its predecessor. So how do businesses and investors take advantage of the market today? Consider a new young business that decides to enter the market. For example, the company may be in the business of manufacturing and selling shoes. It turns out their shoes are really wonderful and popular. Many people buy them. In fact, their shoes are so popular that they do not have enough production capabilities to keep up with the customers' demand. They need a new factory to increase their production volume. The problem is that being a small and young company, they lack money. That's where the stock market comes in to help. The company can first approach an investment banker like Goldman Sachs or JP Morgan. With the help of the investment banker, they will get access to investors from private funds and the general public. They tell these potential investors how wonderful their business is and how much money they need. In return, they offer a part ownership of the company to these investors. Owners of the company are entitled profit sharing depending on their ownership. The more portion they own, the higher the profit sharing is. This profit sharing is also known as dividend. The investors are also entitled to voting rights on major decisions. If these investors believe in the business, they will have first dibs to buy the company shares. The first dibs on the company shares is known as the initial public offering, or IPO for short. Once the shares are sold, the IPO is successful. The company shares can now be traded on the stock exchange. The stock exchange allows the first dip investors of the shares to sell their first dip shares to anyone else on the market, if they choose to do so. Anyone who believes in the business potential can buy these shares. Take note, when they buy the shares, they pay money to the previous owners of the shares and not to the company. As the business becomes more successful, sales and profit will grow. This increases profit sharing. Naturally, demand for these shares grow, and so does the price. This increases the price for other potential buyers, while at the same time increases the value of the shares for the existing owners. However, if the company's business is not as successful as previously thought, the reverse will happen. Sales and profit will fall, profit sharing decreases, and this decreases the price of the shares. If investors believe their share value will fall, they will sell their share quickly in the hopes of profiting before the company loses additional value. Market factors such as fluctuating material prices, changes in manufacturing technology, and shifting labor costs have inevitable impact on business. These impacts may be positive or negative for the company. All of these factors are dynamic and changes on a daily or even hourly basis. They contribute to market noise, which can make the company appear more or less successful. In the stock market, the share price will fluctuate daily based on these factors. This will lead to gain and losses for anyone holding on to the shares. Sometimes, investors are simply selling for personal reasons that have nothing to do with the business situation. Perhaps they simply need more cash to buy a new house or expensive new car. Human market confidence has the ability to cause everything from economic booms to financial disaster. And it is because of this difficult to track element that most specialists recommend dependable long-term investment instead of trying to earn a quick buck trading in and out of the market. Experts, on the other hand, are continuously developing techniques in order to improve their chances of success in this unpredictable environment. Unlike the old times, the stock market is not just for the wealthy and powerful. With the growth of the internet, ordinary individuals may now buy shares in many of the same ways that major investors do. And as more individuals get educated about this sophisticated stock market, they will be able to join in and trade equities, support the company they believe in, and achieve their financial objectives. How about you? Have you made your first stock market investment?